everyone. I must admit that I was really surprised and flattered when Ian asked me if I would present at this summit. Just take a quick glance at the impressive list of accomplished presenters. Then there's me, someone who doesn't have any social media presence or run any outside money. It didn't take me too long to figure out why I'm presenting to you. It's the number of mistakes I've made in 35 plus years of investing and trading capital. Perhaps being older does have some benefits. Given my nearly invisible public profile, here's a bit about me. My real name is Jeff and I'm Canadian. I live in Toronto, and yes, I do like hockey. My country of origin is self-evident to those of you following my posts, since they are predominantly on Canadian-listed companies. I'm definitely guilty of home bias. Since 2013, I have been a full-time private investor. Prior to this, I worked on Bay Street, which is the Canadian equivalent of Wall Street. For just over 20 years, I was a derivatives broker at a couple of Canadian banks and a small hedge fund. A bit more about my past in order to understand the lens through which I view markets. When I started in the business, I wasn't provided with a Rolodex of customers. I needed to go out and find them. Over the years, I built out a wide-ranging book that transacted in dozens of financial and physical commodity markets. I had two types of client, hedgers and speculators, using the same tools for different objectives. Given the diversity in my book of business, I gleaned invaluable insight into the minds of people that were the decision makers, both the good and, of course, the bad. I had a front row seat and I got paid to learn. Most microcap investors are bottoms up with their approach. They look at the balance sheet, management's history, insider ownership, and dozens of other variables. I look at these too, but most ignore the macro. Handicapping what the Fed's next move is, forecasting currency moves, or calculating the geopolitical landscape is downright tough and usually foolish. So the best thing to do is to stay the course on whatever your strategy is and stay invested. There aren't too many George Soroses, Julian Robertsons, or Paul Tudor Jones out there. But when it comes to macro, is it all plain vanilla? I believe there are other types of macro trends. Like, what about the E in ESG? Or what about moving from an analog to a digital world? These types of trends, to me, look more like this. I'd venture to guess that none of you would say that investing is easy. And most of the time, I find it a mix of this and this. The best way to describe my process is a barbell. One side representing the macro look, while the other the bottoms up. Before moving on to portfolio construction and my new favorite idea, I want to mention a long-standing, widely held perspective that fits nicely into the macro part of the barbell, and that is narrative. Many refer to the microcap universe as full of story stocks, and it's true. Some of you may recognize who this is. Many of you have likely heard of him. His name is Daniel Kahneman. He's a highly accomplished psychologist and considered one of the foremost experts in the field of behavioral economics, more specifically, judgment and decision-making. No one ever made a decision because of a number. They need a story. Stories are part of the investing landscape. For centuries, we've told them. As an investor, a huge part of our process is to filter through these, not avoid them. Tiny companies don't become big ones without identifying a long tail opportunity, which some refer to as the story. Constructing my portfolio. Unless I see a 3-year plus runway, I'm just not interested. We've all heard about how investors hold equities for shorter and shorter periods. There are plenty of reasons why this is true. I'm convinced one of them is simple. Attention spans have shrunk as technology has advanced. It's so easy and quick to get reams of info. If the majority of people have shrunk their horizons, shouldn't a thoughtful investor extend theirs where it's less crowded? Finding new ideas that might be your next multi-bagger is hard. I don't find that many new ideas each year. My ideal holding period needs to be correlated to the velocity of my idea generation. I hold less than 10 stocks in my top tier. There are plenty of studies on what is the number of ideal equities to own. For me, the number of positions I own is a function of my practical bandwidth. I don't identify a company, buy it, and forget about it. The ongoing maintenance of staying on top of my portfolio is time-consuming. Once I identify a company that looks promising, I buy some stock, typically 1/10 or less of my max size. Then I take my pulse. How do I feel afterward? Does my initial purchase motivate me to dig deeper? If not, why? Within a few weeks, if I'm not fully engaged with the research process, I just get out. I know myself well enough to appreciate that unless I'm excited by a new name to put in the work, something's wrong. If I become more confident that my research is on trend, I buy more. Management, of course, plays a big part in how big my position will ultimately become. If they aren't delivering, I won't add more capital. Over time, some will graduate into my top tier, but many won't. Buying is easy. Selling is really hard. It's so true. I continue to struggle with this. Overall, my philosophy has been that if your original thesis is intact and management is making progress, then just wait. Recognizing mistakes is really tough too. Dealing with them is even more difficult. My years of trading highly leveraged derivatives and the thousands of losses I've experienced has taught me not to get paralyzed when the facts change. But what about winners? What should you do? Does it make sense to take some money off the table as the stock hopefully runs higher? We've all seen how micros can stay dormant for long periods of time and then violently re-rate. I've cherry-picked 3 examples of companies I've written multiple posts on and what I've done and why. The first is VLE. I held the stock for a few years and then literally wham, it 10-bagged in short order. My original thesis was that enough natural gas was in place to ultimately support $50 a share. So by that, I should have held, but I didn't, at least not all of it. I sold about 20%. With the benefit of hindsight, it's a good thing I did. But the real reason I lightened up was my original position was really too large. Once at 10x, the daily fluctuations became too meaningful to my net worth and painful to stomach. So I reduced. Selling into the spike was the only reason I ended up earning about 2.5 times what I invested. I sold the remaining 80% well after the peak. The second example is UGE. I spent many months accumulating a position in late 19 and early 2020. My timing was uncharacteristically nearly perfect as the stock ran up 6-fold by the summer. I did nothing. That didn't feel too smart since it retraced over 60% since. My original view was that it would be a $10 plus stock, and it still is. The last example is NPK. After years of following this company, I felt like management was starting to deliver on their vision, and I started to accumulate. Over the span of 1 quarter, the stock re-rated by nearly 10 times. I sold 20%. I really struggled with this since my thesis was still playing out. Ultimately, I think this will be a multi-billion-dollar company, which equates to well over $40 a share. So why did I sell some? I'm pretty sure it's because of my experience with VLE, not taking too big of a position from the start, but the pain in seeing it round trip. I hope my experience here is somewhat painful as well, but only because one day I regret selling some too early. So there you have it. Even after decades in markets, I still struggle to be a better seller. Okay, let's move on to my idea. Deveron. The company's mission statement is, we help local agriculture achieve excellence by making impartial data accessible and useful. I think their website landing page is just awesome. Deveron touches more soil than anybody else. Your data is in the cloud. Our people are on the ground. Deveron started out in 2011 as an agricultural drone company. And since then, the company has evolved into acquiring local farm advisors, otherwise known as agronomists. They've also been buying soil laboratories. Nearly 20% of North America's land mass, or 500 million acres, are farmland. On only 30% of these acres are farmers collecting and using data to help them make informed decisions on a variety of inputs, like seed, chemical, fertilizer, and water. It's no surprise that utilizing data leads to improved outcomes through higher yields, climate impact, and of course, profitability. More people are starting to appreciate the importance of soil health. Deveron offers broad-based, vertically integrated exposure to tapping into this via 4 key service offerings, including data collection, lab analysis, crop advisory, and an emerging carbon platform. There are 4 reasons why I'm excited about farm: unbiased advice, a fragmented market, last mile logistics, and carbon upside. So let's unpack these. The world of agriculture is understandably a massive market, some estimates reaching $1 trillion in the US alone. The industry is dominated by companies like Cargill, Bayer, John Deere, Nutrien, and DuPont. Traditionally, agriculture has been a slow, methodical industry that's resistant to change. And that's understandable. Imagine running a business and being subjected to uncontrollable factors like the weather. No wonder farmers are ultra conservative. Their average age is 57. The next generation are more tech savvy and open to change. Given the availability of cheap sensors, robust communication networks, and a better understanding in the power of smart data, these farmers and their suppliers are starting to embrace using technology. Of course, one thing that all these large ag companies have in common is their desire to cross-sell more products and services. There is a saying that the last person you want to ask if you need a haircut is a barber. Do you think Bayer can be trusted if they say to use more chemicals or seeds? Will Nutrien tell you to cut fertilizer use? Deveron has no affiliation with any seed, chemical, fertilizer, or farming equipment companies. Farmers are a tough crowd to gain respect and trust from. Deveron is in a fantastic position to fill this void through their agronomist network, a true and trusted local source of advice. There are an estimated 15,000 crop consultants and 140 independent soil labs in the US. Their combined value is about $5 billion. Most of these are run as mom and pops. Deveron is actively buying agronomy operations and rolling them into and under their brand. At 120 agronomists and counting, they already have one of the most extensive and connected networks in the US. One very powerful reason why these agronomists are attracted to being part of the Deveron network is the ability to free up time and earn more while maintaining an active role within their community. The company estimates that up to 30% of an agronomist's time is spent doing menial back office tasks that get streamlined once they join in. Deveron doesn't have too much competition in consolidating these agronomists, which is surprising given the low multiples they're paying to acquire. So far, the range has been in the 2.5 to 5.5 times EBITDA. And typically they pay 60% in equity and 40% in stock over a 3-year period. The company is starting to call this the first mile. This is the toughest part that no one wants to do, but it can't be avoided. Deere has an attachment on its tractor that scoops some soil, but they don't have a local who takes a 12-inch core sample. There are numerous satellite and drone companies that take various measurements, but none of them can match the quality of high-fidelity data by having actual boots on the ground. As the world continues to evolve towards a more complete, trackable, and transparent food chain, the verification of this last mile is time-consuming and not sexy, yet necessary. The real money that was made during the California gold rush of 1848 was the suppliers of the stuff prospectors required. Things like axes, picks, shovels, and tents. I view Deveron in this light. Soil is the largest carbon sink on the planet. The farming practices deployed do make a ton of difference. I'm not aware of any other company that is measuring, tracking, and warehousing this data under one chain of command. Yes, it's very early days, but Deveron's off to a fantastic start and is super well positioned to be the leader in this exciting area. Although only launched in Q3 last year, Deveron's carbon service already has $7 million in contracted revenue with 6 customers, which include the USDA, Corteva, Bayer, and Danone. While the numbers seem small given the size of these organizations, these are just pilot programs. One of the critical pain points that these Tier 1 organizations face in scaling their budding carbon programs is cost-effective soil sampling and analysis, a critical process in this high-quality carbon credit origination. So why is now the right time for Deveron to enter the big leagues? A few months ago, they acquired 2/3 of Canada's largest soil and tissue laboratory, A&L Labs, for $50 million. The lab processed 435,000 samples last year on behalf of 20,000 farmers. A&L generated about $27 million in revenue and just under $12 million in EBITDA. So on a multiple basis, Deveron paid 6.3 times EBITDA and 2.7 times revenue. Deveron had been working with A&L since 2019 and developed a relationship with the main shareholder and founder who started the business 35 years ago. A shotgun clause was triggered by the two minority partners, which opened the door for the deal. A good portion of the $42 million in cash was used to buy out the minority partners, while the founder took $7.5 million in Deveron shares. He is remaining on the team as the operating president of the lab. There are enormous synergies in buying control of A&L. Last year, Farm collected 500,000 soil samples that were not sent to their own lab network. A&L operated at 75% capacity last year. Just filling this unused capacity alone should add over $1 million to the bottom line. The acquisition also comes with 30 years of data on thousands of fields. This database of soil and tissue samples should be very useful for their carbon service. At scale, which I believe this acquisition brings them, some very attractive margins should kick in. A few weeks ago, Deveron reported their Q2 numbers. Revenue was $5.2 million. A key theme for the company remains how they integrate, realize synergies, and cross-sell these recent acquisitions. While it's too early to see any tangible impact on the organic growth side from their A&L purchase, it's not on the rest of their deals. Organic growth was a very impressive 65% higher, much bigger than the 30% the CEO had been guiding. The company expects to achieve EBITDA positive in the second half of this year. By the back end of next year, they should be on track for $50 million revenue run rate and $13 million in EBITDA. So that's Deveron. And in closing, the 6.5 years since I joined the MCC universe have gone by really quickly. I have to admit that a big part of why I'm an active poster is due to me being selfish. It's easy to think something makes sense when it's in your head. Writing my thoughts down helps me think through my assumptions. And of course, feedback from our awesome community helped too. Hopefully some of what I said resonates with you and will help you make fewer mistakes along your investing journey than I have. Thanks for tuning in. I appreciate it.